Okay, welcome back. We're going to talk about today Chapter 11, which is where we talk about forecasting the financial statements. And mainly what we're going to talk about is the mechanics of forecasting. In other words, how do we actually take historical financial information from the firm and translate that into forward-looking information or predictions about the firm's behavior in the future. Right. And so we're going to break this into sort of a 6-step process where we start by talking about what the appropriate level of detail is in our forecast. And this is where we come back to the idea from early on in the class where we're looking at 3 distinct time periods. Where the first time period is a very explicit forecast down to every single line item in the balance sheet and the income statement, and sometimes even farther than that. For instance, a line item in the income statement is revenue, but a really detailed forecast might actually forecast units sold and prices rather than just revenue. And so we want to, at least in the very beginning, have a very explicit forecast. And then in the second period, we're only going to forecast what I call the bolded items. And those are just the big things from the income statement and balance sheet. So revenue, EBITDA, EBT, and net income. And on the balance sheet, just like current assets, fixed assets, total assets. Okay, the big bolded items from a very simplified version of the balance sheet and the income statement. And then the final period is where we use the key value driver formula to estimate a perpetuity, and we take we just assume basically the very smallest level of financial information, which is NOPLAT and invested capital, in our key value driver formula. And that is what we call the continuing value period. Now the second step is we're going to talk a little bit about how to actually build your model inside of Excel or whatever spreadsheet function you're using. So we're going to talk about the easy do's and don'ts about how you should set up a model for a structured DCF analysis like this. We'll talk a little bit more about it when we work the big example that we'll do in this chapter. And I've shown you before a really professional version of a DCF model. And if you guys are interested, I can put that up on as you learn too. Step 3, we're going to talk mechanics. How do we actually take historical information, turn it into future predictions? And so we'll work a big example in this chapter, a big Excel example. It's on As You Learn. There's videos here walking you through it where we do all the forecasting. This is how it's going to tie in a big way to your fourth homework. So in your fourth homework, you're going to be doing forecasting for a fake company as part of a big DCF analysis for a firm from start to finish. So I've given you some historical information. You'll use that to forecast future predictions about the firm, and then we'll turn that into a DCF model at the end. Okay, so first we need to talk about the length and detail of the forecast. And again, I've already given you a brief overview, but and for every individual firm, the breakdown of the forecast periods is going to be slightly different. But a good general rule of thumb is you want about 5 years, 5 to 7 maybe, a very detailed forecast, down to as many links to like real outcomes as you can. Again, if you're forecasting revenue, you don't forecast revenue, forecast units sold times price per unit. And if you're forecasting costs, forecast units sold times cost per unit. Forecast your fixed cost using the information provided by the firm, and as much of it as you can. If you're inside the firm, you have literally all the detail in the world. If you're outside the firm, some of this is going to have to be estimated, and sometimes we're just going to have to go with the line items themselves instead of the individual drivers of the line items. In other words, if I'm outside the firm, I'm just forecasting revenue. But if I'm inside the firm and I have full information, I should be forecasting the real variables that input into and drive revenue. Okay. So that's 5 to 7 years. Again, this is dependent on the type of firm. Once we move on, anywhere from 6 to 15 years out, sometimes 10 depending on the type of firm, but somewhere in that range, the next 5 to 10 years, is a much more much more simplified forecast, where we're really predicting just the big things. We're going to maybe do a simple income statement balance sheet prediction, and then again maybe taper that off and into just a predictor of just the big bolded items. So sometimes I like to do maybe even like a 4-step process, where the first 5 years is really detailed, the next 5 years is a little less detailed, the following 5 years is just bolded items, and then from 15 years on, at that point it's totally a wash. Our predictions 15 years out are crapshoot as it is. So any farther than that is just a waste. And what we do there is we just forecast the things we need for the key value driver formula. So NOPLAT, the tax rate, ROIC, and that's it, right? We're just interested in the major value drivers, and then we're using that to calculate the continuing value, and that's the remainder of the value of the firm, right? So in each of these 15 years, we'll use the financial statements that we're predicting to generate NOPLAT, invested capital, and free cash flow. And then the value of the firm will be the sum of the present values of these free cash flows plus the present value of the key value driver formula, which is the perpetuity value of the firm, the value of the firm from year 16 plus to year infinity, potentially. Now, again, this is just an estimate of what we should do. For certain kinds of firms, it's not going to be appropriate, particularly firms that have very cyclical industries. So you can imagine firms like airlines have very cyclical industry. The behavior of those firms is very dependent on the behavior of the economy, which tends to move in cycles. And so what we want to make sure when we're looking at something like a cyclical firm is not necessarily that we stick to this 1 to 5, 6 to 15, 15 plus breakdown, but that what we include in our explicit forecast is an entire cycle. So a boom cycle and the bust part of the cycle, and then we move on to our less explicit forecast and our continuing value. Right? So we have to be really careful when we're looking at firms to try to understand the way the firm behavior guides the financial performance, and not just the other way around.